Okay now.
There's a lot of noise, background noise. Okay. Hi, everyone. Welcome to this live event. As usual, I will review this week from the fundamental and the technical point of view. So let's start taking a look at the calendar and see what's in there for these days. Okay. I was thinking that, of course, the most relevant thing that we should care about is that we have both Yellen and Draghi speaking this week in different events. I believe that none of them is a scheduled central bank meeting, but it's still a speak that they will offer. And the market is always looking for clues about whether they will keep on easing, keep on tightening, if they're dovish, if they're hawkish, to determine where the currencies may go, right? So I believe that sort of part of this quietness we are seeing in the markets these days, it's due of the market uncertainty over what they may say during the upcoming days. Okay. Anyway, taking a look at the calendar, today's services and market composite PMIs in the euro area who had their final revisions for March and were slightly below expected, right? And still, the euro is not yet ready to fall because it has been holding above Friday's low 1333. And I don't see much of downward potential in there still because negative data or downward revisit data has not been enough to put it down, right? If a greenback is gaining a bit against other currencies, is due to sub-weakness of those other currencies and partially of risk aversion. Really not sure what triggered such risk sentiment today, but the Nikkei plummeted, right? For the third day in a row, it break many support levels, and that is driving European stocks also lower, and therefore we are having some yen demand, some yen strength. Overall, we are in a risk avert environment, so we should take a look at the calendar with those eyes, right? If data is showing that growth is slowing any economy, it will probably mean that we will have more Shen and gold gains and more stocks plummeting. Anyway, as I was saying, we have some good numbers this week. The first will be during the upcoming Asian session, the Chinese services PMI. Chinese data has been quite relevant lately because all of these global slowdown fears have been triggered by China and poor macro readings. Overall, and as in other many economies, the services sector is the one growing the most. Most economies are being sustained by growing services rather than in manufacturing. So the number may not be a big disappointment. However, if we have a reading below 51, it would probably imply further risk aversion, further stocks plummeting, and more yen and gold gains. Anyway, we have the minutes of the latest minutes of the ECB and the Fed tomorrow. So that's what I was saying earlier. Beyond the speeches we will have on Thursday, right? Draghi and Yellen votes will be on the wires on Thursday. So actually, I believe that the big first market reaction we will have tomorrow will be late in the American afternoon with the FOM minutes, right? Because we will have the ECB, but guys, Draghi is not willing to offer us something different. I can imagine what else he can do, right? After all of his said in the latest meeting and all the extension quantitative easing and the comments from European authorities, policymakers saying that they are willing to extend negative rates further deeper in the case they need it. Honestly, I don't expect the minutes to offer much, right? And in the Fed, however, the market will be looking for the wording. In there, really not much surprises. The most probable scenarios that will say that the employment sector remains strong, that they are still concerned about inflation, and the risk of a downward pressure towards inflation is coming from outside, right? But mostly what we have heard lately. So honestly, not much taken out of the minutes, but the speeches will be probably be more relevant because they will have to answer questions, and journalists may made some spicy questions, and therefore they may say something that is not something that not something that we can read between lines in the minutes. Okay. um, on Friday, I do believe that the pound has been underperforming too much, right? So I'm expecting this manufacturing and industrial production data from the UK being quite relevant because I would expect it to actually determine if the pound can regain some ground or not. A steeper recovery, a more sustainable recovery, I'm looking at the previews and the forecast, and they're quite negative, right? So maybe the underperform scenario of the pan will probably extend for one more week. Anyway, let me go to the charts, which are far more interesting. If you Okay, here we are. Okay, here we are. Uh, let's start taking a look at the euro, right? As you can see, we are close to the year high set last week at 1437. In fact, it was the level reached previous to the release of a quite solid US non-farm payroll report. I have mentioned many times, let me change to the weekly, that around this region, 1460, 1470, right, we have a major resistance given that the pair has been unable to really extend beyond that level ever since January 2015. Given that the pair stalled its rally last week at barely 25 pips above the level, it's quite a relevant signal. But what I am watching right now is that despite stalling at that level and retracing some, the retracement has been for the most shallow, right? We are what? Uh, Nearly not even 100 pips below that high. So the high post last week. So that's why I'm saying that I'm not saying much of a bearish case for the euro. In fact, I could say that we need to take down 1250 region, which is also a major static support level, to try to think about a more bearish euro. In the meantime, I could expect some consolidation and any good excuse being taken as buying opportunity, maybe a dovish Yellen, a less dovish Draghi, a slightly negative report in the US, or a slightly positive one in the euro area, right? Anyway, and for the short term, the 1410 region, right, in here, it's the immediate resistance. I do believe that if the pair manages to advance above this level, we can go up to that 1460 region. And if we trigger stops beyond that, there will be see a quick spike towards 15. Some gains beyond that 15 level will probably signal a continued advance up to the 1720 price zone past August high. So we are standing at a critical breakout point, right? We are standing there, and there's not much we can do against it. Honestly, there's nothing telling me that the pair may retreat. Short term, also, we have an immediate support around 1330. We have former highs, Friday lows in there. So my take is that if we break below that level, we can go down to 1280, 1290, where the pair has also several intraday highs and lows. And if we take this level, then we go back down to 1240, 50, where I said before that there's sort of a line in the sand, right? If I do expect some buying interest to surge and approaches to that level, so maybe buying around this line with the tight stops could be a good opportunity. Okay. Uh, if for the pound, I was taking a look at the daily charts, and we keep on making lower highs, right, weekly basis. And as I said, most of this decline seems a bit overstretched. I do believe that fears of a Brexit had been way exaggerated, right? But they're still there, and the peer is closer to 140 than to 145, which means that technically the risk remains towards downside. In the daily chart, as you can see in here, price has been unable to move beyond the 20 simple moving average ever since the week started. And rally yesterday beyond 43 was quickly reversed, and we are now at near the weekly low. So that increases the risk of a downward continuation during the upcoming hours, particularly if somehow the dollar keeps strengthening. Take a look at that 41.70 level as the immediate support. If we pass it, I would expect the pair to retest that sort of double bottom we have set around 40.50, right? And if we lost this one, then the bearish potential will be far bigger, and we will probably return to the lows set around 38, 30 late February, okay? The risk remains towards downside despite overreact to. Anyway, 40 to 50, 60, it's like a short-term line in the sand for bears. If we get above this level, bears will probably desist a bit, and the pair can go back towards the 44 price zone. Although I would really like to see a break above this 45.20 level to talk about more constructive scenario here. Honestly, I don't expect it until the Brexit, right? We are what, 2 months, almost 3 months away. Until then, I would expect the pound to remain subdued, right? The OC bullish tone that we have been following for weeks and weeks seems to be finally fading. Okay, we are approaching 75. The Reserve Bank of Australia yesterday, or sorry, in the past Asian session, expressed their concern over a strong Aussie, right? It's not that a central bank expressing concern about the strength of its currency will do something to affect it when we have a strong trend. But maybe it could be enough to trigger a downward corrective movement, particularly because the pair has been rising way too much ever since bottoming around 68 early this year. Anyway, the key right now, of course, will be 75, right? The round number, it's always a critical level, particularly when it comes to commodity-related currencies. And if we take that level, we can go down to this region, 74, 74.20, and that's a probable bearish target. I would say that these highs former highs around 73.80 are the line in the sand, right? If the pair has to recover its bullish strength after a downward corrective movement, it could be from here. Okay, if the level holds, then we will probably see further strength. It will depend, of course, on how the dollar reacts and if the dollar is able to correct back higher to gain some momentum or not. Because if the dollar remains weak, I hardly expect the pair to reach this level, and it will probably resume its advance after probably being rejected or meeting buyers around 75. So take a look at that round numbers, guys. In let's go shorter term. Okay, there in the forward charts, from what I can see, we have some resistance intraday one around 75.60. So if we recover this level, the pair will probably return towards this 76.40 region, which is its comfort zone. It has been for long lately. And above this one, I do expect a retest of the 77 region. Still tough because bear has been rejected plenty of times intraday from around this region. I'm still not seeing clearly a break above this level. But if we have, again, positive data coming from Australia and negative one coming from the US, the pair will probably return towards the upside. What's also waiting on the Aussies oil. Oil has been smashed lately. It returned towards the 35 region. All of those hopes of a output freeze had been diminished by Iran and Saudi Arabia. Iran said that they won't join the output freeze. They will keep producing and exporting until they reach their market share they had before the sanctions. And Arabia Saudi said that they won't freeze output if Iran does not join the deal. So pretty much they're saying that in the upcoming meeting we will have this April, they will have no deal, so no output freeze, and therefore no higher oil prices. Anyway, we have the 61.8% retracement of the February-March rally around 34.80. So that comes for me as the immediate support. And if we take it, I'd see the commodity, plummeting back towards 33.30 region and even lower down to 32. Okay. And regardless, Australia is not an oil producer. The Aussie has been quite linked to commodity prices lately, to the crude behavior, so it will probably be under pressure. Okay, gold has recovered some ground, and Aussie didn't today. Of course, this is part of the risk aversion environment I was talking at the beginning of this coverage, this event. Stocks are plummeting, so investors are seeking for safety, and here we are with gold still going higher today. Still, what I am following in the daily chart is this 20 simple moving average that has turned south, and for the past 2 weeks has been acting as a selling level. Right, approaches to the 20 simple moving average had resulted in a retracement. So I would like to see the price moving above it, above 35, even better above 40, 1240, right? To talk about a more bullish case for gold. Okay, if we regain 1240, I would expect it to return towards a 1270, 80 region pretty much in a couple of sessions, pretty fast to be honest. And if you take a look at the chart, you will also see that we had been trading at lower lows lately, 2 weeks lows, 3 week lows, 1 month lows. So uh, I'm still not disregarding the potential of a break below 12, right? Uh, we have an immediate short-term support at 25.30. So if we take out that level, right, and again being rejected from 20 simple moving average, there's a good chance that we will go back towards 1200 during the upcoming hours, right? The sessions, sorry, no hours. And for the dollar Japanese yen, okay, well, Japanese yen is stronger, commodities are plummeting, as I said. So the pair reached 10.25, too close to 110 to think about a reversal yet. I was reading earlier today that the Bank of Japan has been making the rounds, making calls, jawboning in general about the strength of the yen, and that they are concerned about it and asking for the value of the currency's pair. Anyway, as I said before, there's little a central bank speaker can do to turn a pair when there's a strong trend. And I do believe that there's a quite strong trend in here because we are below 111, which has been a major support. And even before that spike we made last week, or the previous one at 1066, right? So the risk towards the downside is quite big, and it will be even bigger if we lost 110, okay? If we lost 110, I will go to bigger time frames. We can go all the way down to 106.20, which is the main bearish target if we lost 110. Okay, beware of that. And if the dollar keeps weakening and the Fed maintains that dovish tone, we will get there quite fast. Anyway, and short term, 1020 has been low, 25, sorry. So I do believe that if we take it, we can go all the way straight down to 110 pretty fast. And if we break below it, it will probably trigger stops, sorry, and offer 60 pips, 60, 70 pips bearish movement right after that. Okay, beware of that. 1060, of course, 70 is the first resistance in the short term, sorry. 111, right? I could expect some sellers to surge if we go back to 111. Beware of that. If that happens, that will confirm the bearish risk and probably push the pair even lower. right? And honestly, there's not much I can see above this 111 level. Okay, and I was watching also today the fact that the European equities are falling big and are about to take I'm sorry, mark lows. Okay, so that will probably keep the risk averse scenario and probably support the euro because uh, low falling equities in Europe have tend to support the euro lately. Beware of that. Those stocks keep plummeting, the euro will keep on finding support. Still, remember 1410 in a year. Anyway, and the other things that's quite relevant is Dow Jones and in general US stocks that are retreating from fresh year highs post late last week. So, so that's another factor weighing on risk. We are far away from the 17 level, right? But I do believe this region 17,550 is the level to watch right now in here. Not because I want to trade yes, but because if we plummet below that level, then probably we will see the slide in here, deeper slide in here, and more gains in Europe. Okay, guys. And the last thing I would like to say is that the pound it's also been correlated or acting in regards of oil prices. So if oil prices remain weak, pound will probably continue falling. But if the price in the air manages to bounce, it will be given a bit of support to the pound. Anyway, there we are approaching that 41.70 support. Remember what I said, if we break it, I will probably continue falling. Okay? Okay, guys. I believe that's it for today. Okay, I'm trying. Okay, here I am. Thank you for being here with me for a while and see you back soon. Okay, bye bye.